All right. So we discussed the various sources of finance for a business, that there could be discrimination on the basis of for how long or what's the period in which the business would require finance. So, for example, just at the startup stage. Hmm, 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 hmm. Just a small thing for finance, the description that you're giving is all automatically assuming that you have to pay it back. You have to pay it back only in the case when you have borrowed it. But when you're using the equity financing, the financing that is provided by the owner of the business, then you don't have to pay it back, right? All right. Acha, so now we are to continue. We had discussed the short-term finances. For the long-term finances, the first thing that we'll discuss is mortgages. Is it working? It's not. Can I make it work right now? No. Screen is stuck. Perhaps I need to get a new laptop altogether. Oh my. Maybe 4 years. Even then, I bought a used one, but it wasn't like used for a very long period of time. Back then, it was like somebody had used it for a month or so and then sold it. Time to go to my brother. He usually manages these things. All right. Acha ji, so for long-term source of finance, the first one that we'll discuss is mortgages. What is a mortgage? Yes, mortgages are usually used for properties, uh, land or property, and so the way it would work is that you'll have something as collateral or security, and then the since the property it's a huge purchase, they'll give you sort of financing. You'll immediately get possession of the land, or as per the terms of the agreement, at an early stage in the agreement, over the whole span of agreement, you'll get the possession of the land, and over the period of your usage of the land, you'll be paying installments, and all along you'll have a collateral, which would be kept as security in case if you ever default on payments or multiple payments. The person who has extended this mortgage, they can sell that asset, and then they can uh, sell that asset, recover their money, and maybe you get the rest of the money if there is any surplus. So mortgage is having something, some of your assets pledged, and as a result, you take a big amount of loan for 20-25 years, which is usually for the purchase of some property. Acha. Another very common form of long-term finance, and especially for incorporated businesses, debenture. Okay, what is debenture? For debenture, first we'll have to understand the concept of shares, which you perhaps already know. So we'll just recall. Share capital, the way it works is that you say, I want to raise $1 million for my business. Okay. And then those $1 million are distributed in share certificates of $1 each. Right. So anybody can buy as much number of shares as they wish to buy. So that way the whole burden is not necessarily on a single person to provide this whole finance. It's distributed in the market, and also you get to raise this big sum of money. The same is for debentures, but loan. So debenture is basically a loan, and now you're not taking this loan from a single institution such as bank or some other lender. What you're saying is that I need this huge sum of money, perhaps the same as this $1 million example. And now you are dividing that loan into smaller certificates. Okay. And smaller certificate into smaller parts, and each part, what it would enable the person who is getting the loan is that they'll pay some principal amount which they'll pay you as a loan. On the face of the certificate, that would be mentioned that after 3 years, 4 years, 5 years, whatever the term is, this certificate will be redeemed and this much interest will be paid per annum. That will all be accumulated, and at the date of maturity, this certificate, it will be paid back to them. Now, once they get the certificate for the debenture, they can trade it in the market the same way as if they had bought equity of some business for which they are entitled to dividends. If they get debentures, they are entitled to interest payments. And the same way, equity share certificates, they can be traded, they can be sold or bought in the market. The same way, debentures, they can be sold or bought in the market. Okay. Okay. Another form of long-term finance that is available for the business is hire purchase or lease. Okay. So hire purchase or lease, the usual form it takes is that you want to buy an asset, you do not have the money to buy or to make the payments for the asset upfront. So what you do is you pay rentals over the. So for example, I need to buy a car. How much does a model of Ford or any car cost in dirhams? All right, let's say 100,000 dirhams. So they'll say that this whole 100,000 dirhams, it will be divided into 5 yearly installments. Each installment you will pay us 20,000 dirhams. Each year you will pay us this installment, and then at the end of that period, after 5 years, you will be allowed the option that if you want to buy this particular car, you can buy it for just 5,000 dirhams. Okay. So this is hire purchase, that initially you are hiring the asset, and since the life of the car is usually around 5 years as well, so over the 5 years they'll extract the majority of the payments, the whole value of the car for use, for allowing you to use over that period, and then at the end you'll be allowed an option to purchase that asset at a very minimal cost. Hmm. So if you wanted to buy the car upfront, you would have been charged 100,000. Hmm. Hmm. When you want to buy an asset, but you do not have the money to pay upfront for it, so the seller of the asset or a third party, they make a payment plan for this asset. That payment plan would mean that the whole sum that you had to pay upfront, they'll make you pay that in installments and slight bit above. So let's say you'll pay these installments. Upfront amount was 100,000. So they divided that into 5 years. That turned out to be 20,000. But they said that's just uh, turning the whole amount, dividing the whole amount over a period of 5 years. What do we get out of it? Let's say we'll charge the sixth installment as well of 20,000. So what we get in total is 120,000 in installments. Okay. The down payment, they might ask you to pay this 20,000 right up front. Whenever you are buying an asset, and any amount that you have to pay upfront, that is down payment before you get that asset. Okay. So they're asking you in totality, they are asking you to pay 120,000. This additional 20,000 is for allowing you to pay this in installments. Otherwise, if you want to pay upfront, the amount would be slight bit lower, 100,000 for example. And then after you have used the asset for 6 years, the asset, you will be allowed to buy this asset at a very minimal price, 5,000. So you're basically hiring the asset, and then you have the option to purchase it towards the end of the agreement. Okay. Acha, and then the most important, or perhaps one of the most important forms of external long-term finance is equity. Acha ji, equity is that you already have, let's say, 100,000. Let's say you started a business and you have got, if you're starting a business, if you're talking about equity or share capital, instead of equity, let's use the term share capital over here. So, share capital is that if you want ownership in the business, you have to pay this much of share. You're getting a share in the capital of the business. So let's say you start a business and you say that we have got 100,000 shares and each share is worth 10 dirhams. Now it's up to you to buy as many shares as you wish to buy. Any person in the market, they can buy the shares that are up for sale. And let's say you say that I'll keep 50% of the shares for myself and remaining 50% I'm allowing the market to pay. So that way I retain the ownership of the business as well. Later on, out of my 50%, if I keep on selling, I can reduce my, or I can dilute my share ownership by selling. So what happened is that initially we issued 100,000 shares of dirhams 10 each, and out of those 100,000 shares, I retained 50% or 50,000, and 50,000 I allowed the market to buy. So that way I make sure that I own 50% of the business. Okay. Now, let's say for my personal needs, I need cash. Okay. I'll sell out of these 50,000 shares, 10,000, I sell more in the market. So that would mean now I own 40,000 shares or 40%. And in the market, there are different people who own 60,000 shares. That number of shares is distributed in the whole market. Okay. Anybody, if they accumulate more than 50%, let's say out of these 10,000 that I had floated in the market, there was someone who wanted to acquire my business. They went on and they purchased 55,000 of these shares which are floating in the market. They'll become owner of the business. They'll become the controlling shareholder. Since now my ownership is just 40,000 shares and their share ownership is 55,000 shares. Okay, this is one scenario that can happen, and this is a problem with publicly traded companies, public listed companies, companies which are listed on the stock exchange, public limited companies. That if usually what happens in advanced markets is, for example, if you look up the ownership of Mark Zuckerberg for Facebook, it's around 12 to 13%. He's the owner of the business and he owns just 12% of it. The remaining 88%, it is so much spread out in the market that it is very difficult for any single person to acquire more than 12% or 13% of it. So even with 12% ownership, he is stable and he knows that he controls the business. He'd keep controlling the business. There wouldn't be a person who'd end up owning more shares than him and as a result become the controlling shareholder of the business. Okay, the way that market is structured. Monopoly is different. Monopoly is that if you are uh, in a market, if you're selling a product and you own majority of the market. So for example, for social media business, you could make a case that they have a monopoly in social media business as well, as they own majority of the social media platforms, or they own more than 20% of the market. But within a company, for share ownership, we do not use the term of monopoly. This is share ownership. Who owns how much shares? Monopoly is when there are businesses in the market, in the whole market size, which business owns how much market share. Okay, that is where we use the term monopoly. Here we do not. Acha, this was one scenario that just to give you the idea that how equity determines the ownership of the business, that whichever person owns the highest percent of equity for a business or share capital for a business, they'll become the owner of the business. Acha, another scenario that we could discuss is that let's say we had issued these 50,000 shares. I had kept 50,000 for myself and 50,000 I had floated in the market. Now I want to raise more share capital. Okay, I see that this much share capital that I have raised, it has served me for some time. Now I need more finance and I want to expand my business. What I will do is I will issue 10,000 more shares. Sorry, 100,000 more shares. So I want to double the share capital. What would happen is that if I issue more shares and if I allow a third party to straight away buy these 100,000 shares, uh, the existing owners, they will no longer stay the owner of the business. Okay, their ownership, it will be disturbed. So what the law says is that whenever you are issuing new share capital for a business which already has some share capital, first of all, this thing is called right issue. Right issue is when you are issuing new share capital for a public limited company, limited by shares. Okay. Acha. The way the right issue has to work is that whatever new shares you are offering, first you have to offer these shares to the existing owners in the proportion of their existing ownership. So when I am issuing these new 100,000 shares, first I'll have to offer 50% to myself and 50% to these existing the other market, everybody who's owning whatever percentage they own, that we are issuing these new shares. And since you already have these shares, we are asking you first if you want to buy these and maintain your uh, ownership percentage in the business. Because if anybody chooses not to, then their ownership will be diluted. Okay. So for example, let's say the whole market, they all said that yes, we will exercise this right of ownership. So out of the 100,000 new shares issued, we'll buy 50,000. Okay. However, I denied my right. I said I don't have the money or I don't need to buy more shares. So I'll allow these to be bought by anyone in the market. So 50,000 are bought by someone else. Now what has become, out of 100,000, sorry, 200,000 shares that are there in the market, 100,000 are owned by this group. So they own 50%. 50,000 is owned by a new group of shareholders and I own just the old 50,000, which means my ownership has diluted from 50% to 25%. They have maintained their ownership of 50%. And this new group, which previously wasn't the owner in the business, now they have 25% ownership of the business. Okay. It might sound a bit tricky at the start, but this is how issue of shares work. And I'm giving you details a bit beyond what will be tested on this topic as of now. But since we are studying this topic, I wanted to give you an exposure of how these things work out. Okay, so you'll time and again hear this term that whenever new shares are issued, ownership of existing shareholders, uh, and if they choose not to buy it, then their shareholding will be diluted. Okay, so it could be what if they don't have the money to buy these new shares? For these new shares, they'll have to put in the money as well, right? It's not that they'll have it for free. Hmm. 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 Right issue. When the right issue it happens, first they'll be asked that do you want to, in order to maintain your 50% ownership, we are issuing, since we are issuing new shares, you'll have to buy 50% of this new stock as well. If you buy it, your ownership will stay intact at 50%. If you don't buy it, then it will get diluted. All right. Okay. So now another thing that we have to understand is that sometimes we are asked to make a comparison that what is better for a business. Should they go for issuing more share capital, or should they go for raising loans or offering debentures? So this is called equity financing when you're issuing new shares. I might have been using this term a lot before as well, and I don't know if you fully understood it back then, but now perhaps you do. There is equity financing and there is debt financing. Equity financing is when you want to raise more finance for the business by issuing more shares, and debt financing is when you want to raise more finance for the business by uh, taking on more loans. Acha, what would be the pros and cons, or what would be the comparison between the two? Do you have anything in mind on that? Uh, Good. So it gives you ownership. First of all, the advantage is that it gives you ownership in the business. The debt financing, it does not give you ownership in the business. You do not become owner, you are just the financier of the business. Okay. The other thing is it doesn't give you the ownership of the business. Sorry, come again. Debt, debt financing, equity financing versus debt financing. No. Debt factoring is when you sell your accounts receivable debt for lower than the original price. And debt financing is when you're taking loan, when you're obtaining loan to finance your business. Debt factoring is we okay, the debt financing that we had talked about before was one we when we talked about debentures, and the other when we talked about short-term bank loan. This is also a debt. Okay. And when we talked about debentures earlier on, this is also a form of debt financing. So debt finance, hire purchase, sorry again, hire purchase leases, it could also be a form of debt financing, yes. But the debt that we're talking about over here in comparison with equity is share capital versus debentures. So here we mean share capital, and here that we mean debentures. Okay. So first of all, the share capital, it would give you ownership in the business if you buy on a share capital of any business, or if you look at it the other way, if you get more financing by offering equity, by offering share capital, it will dilute your ownership. For the existing business, it will dilute ownership, and it will not dilute ownership. Understood? Another. Hmm. Share price acha, huh. For the share price, what happens is that yes, once you buy the shares, most often the case is that if the business is profit making, the value of share in the stock market, it would increase. So that would give you. The owners of equity, they get return in two form. They get return in the form of dividend, and they get return in the form of share value appreciation. Okay, the debt, people who have bought debt of a business instead of equity, they get return in the form of interest. So their return is fixed, and here the return is variable. So we can write that over here as well. First of all, fixed return, and here you have variable return. And fixed return also we can explain that it is in the form of interest, and here the variable return, it takes two forms. It takes the form of dividend, and it takes the form of share price appreciation. Okay. Acha ji, this discussed, for debt we mentioned, for equity it doesn't have to be paid back. There are very rare circumstances when businesses they buy back their equity, that is beyond your course. So for now, what you learn is that equity, it's permanent source of finance. It is not to be paid back. And even when the businesses, by the way, they choose to buy back the equity, it's voluntary. I don't think it's mandatory in any case. I can't remember of a thing that would mandate the businesses to buy back equity. Anyhow, the debt, it has to be paid back. Okay. Acha, ownership, dividend. Okay. And obviously, for the return that we have mentioned, if the business is loss making, there wouldn't be a dividend and there wouldn't be a share price appreciation. But for debentures, they will still have to pay interest. If you had bought equity or share capital of business A and debentures of business B, both businesses they make loss. Okay, the business for which you had bought equity, you won't get any return on it. Rather, you could have the negative returns. Okay, but for the debentures business, even if the business is making loss, they're still liable to pay you interest as per the debenture certificate, whatever percentage is mentioned on that agreement, regardless of the fact that they're making loss or not. Acha. Another thing is that if you pay dividend to your shareholders, so it will not reduce your taxable profits. Dividend does not reduce taxable profits. However, the interest that you pay on the debentures, that is a tax allowable expense. So in both cases, you are paying returns to the group of people which have financed your business. In one case, that return, it will reduce your taxable profits, so it will benefit you. In the case of debentures, in the case of equity, it will not reduce your taxable profits. ठीक है जी, noted. Acha, these are the main points that I can think of. Later on, if we come across a point that could be added to the list, we would do that. Acha, you'll give me a minute. My daughter has just woken up. Just a minute, please. Acha ji, the next form of financing for the businesses that we'll discuss is venture capital. Acha, the venture capital, it's just mm, the sort of group which provides you this finance and the stage at which they are providing the finance that makes them a separate source of finance. Otherwise, the finance that they will provide is either debt financing or equity financing. So let me write over here number 5, venture capital. Acha, the way venture capital works is that you have got a startup, ठीक है जी, and that startup in order to expand it needs finance. Acha, the finance that they'll be looking for could be in the form of debt financing or equity financing. Acha. So how does the venture capital come into play? If they go to the market, they are not a public listed company as of now, most of them. So, or they haven't met the criteria which is required to be met for a public listed company. So they can't raise money from the stock exchange by offering their shares. Okay. Similarly, if they go for financing from the bank, the conditions that they put, they are obviously also too much for these businesses to comply with. So what they're looking for is a group of individuals who call them venture capitalists. And what these businesses do is they specialize in providing finance. Sometimes this is called seed capital, and sometimes it's called early stage financing funding. These are just different names. They specialize in providing finance to startups. And what they're essentially doing is they are, for example, making a gamble on which startups they'll kick off, and their investment it will be multiplied many times, and which startups there is a risk that this startup totally fails. Not all startups they turn into profitable businesses or viable businesses. Sure. Yes, sir. Because for venture capitalists, I was telling you that these are businesses which specialize in providing finance to the startups, and what they do is they are essentially the business. It is in a tough position that nobody is willing to invest in their business. They are. It's difficult for them to get loans at this stage, and it's difficult for them to offer equity. So these are the people who have seen this situation many a time. So yes, they are willing to invest in your business, but in return they'll ask for either a high percentage of debt. So percentage of debt will be high. Whenever there is an additional risk, there should be some additional advantage that the financier would seek. I'm providing you finance despite the additional risk, so I should get some return over and above the normal returns. With higher risk should come higher return. Acha, so either they'll ask for a higher percentage of interest on that, and that might not be as problematic. What they usually ask for is a good chunk of equity, a higher percentage of equity in the business. Okay. And the businesses, they are up for this risk that since we are approaching the venture capitalist, this is what they'll ask for. And obviously, there is a to and fro bit in the form that how much should be the actual amount. But eventually, if the businesses they become really successful, that investment, that initial investment for the what's this called venture capital, just for providing a small sum of money at that early stage, they get a, for example, five. Yes, it is usually for startups. So for example, a public listed company wouldn't, I can't think of a circumstance that it would be going to a venture capitalist for financing. Okay. Acha. For a few, for example, for Facebook, there was this investor with the name Peter Thiel. He provided them early source of finance, this venture capital. Acha. Excuse me. Acha, they come into play, the venture capitalists, when they have a semi viable or a viable product already. It's not that I've got just the idea and the next day I go running to a venture capitalist. Somebody might, but usually what they'd ask for is that at least you have something that you're already working on, and now you are asking for money, not purely based on idea or paperwork. All they need to see something that's already happening. Okay. Acha. Another thing for all businesses, even I'll give it to you as a homework that you can find it out for Facebook. Hmm. He has invested in a lot of businesses. This was initially called the PayPal Mafia. There were three, four, or a few people. The owner of LinkedIn, Elon Musk, uh, Peter Thiel, they all were this PayPal Mafia. They together started PayPal. And later on they went on investing in other successful business. For example, this Reid Hoffman, he started LinkedIn. Elon, he started SpaceX and Tesla. Hmm. Peter he is the most famous among them for sure, but for success you'll have to see numbers if you're judging that numerically. All right. Acha, so for Facebook, for Amazon also, he gave away some funding, some equity for a low price. For example, if he gives away 5% of shares for whatever X amount, let's say $100,000. Let's say today that 5% equity would call more than a million. Okay, just because they were providing you finance at that early stage for a short sum of money, they bought a higher percentage. That's how it works. Acha, the last one that we have for external financing in your syllabus, that is crowdsourcing. So six is crowdfunding. Sorry, crowdsourcing. I said crowdfunding it. So as the name suggests, crowdfunding is that you have a crowd and you ask them for fund. Okay, so what you do is you set up a fundraiser, and you say this is an event, this is the business that I'm seeking investment in, and what I'd like you all to do is that this is the target amount that I'm seeking to raise. uh, Sometimes they would happen in physical space, but most of the times these crowdfunding events that be happening in virtual space, as in over internet. So you'd announce this event on a website, or it could be some fundraiser event actually where you are present, and then there would be a number put up on the big screen that this is the funding that we are looking for. Then somebody would pledge that, all right, I pledge this much amount, I'll provide you this much amount for the business, I'll provide, and then it keeps on happening. You have different people give talks and keep pumping the crowd until you get your required amount. The crowdfunding, one thing to remember, it can take three forms. The crowdfunding, it could be in the form of donations, which is rare, and it would be for not for profit businesses. But for profitable businesses, they'll be seeking either equity or debt. Hmm. For donation, the return would be in the afterlife. For equity and debt, you get return in this life, as in the monetary return. And we have already discussed the form of returns that it takes for equity and debt. Most likely, it is going to be donations or equity for crowdfunding. However, it could be for that as well. The target, again, the mechanics, I mean, the larger picture is the same. You need a sum of money, and for that sum of money, it will be provided by the crowd. So you gather the like-minded people together, you announce an event, you have somebody motivating the crowd all along, and until you get, there is some time specified for the event as well, that the event would start at this time and at this time, and your target is to get that amount raised by that group of people as soon as possible. Okay. Again, it would depend on the owners if they have raised up the right amount. If they're seeking donations, they can go on collecting more donations. If they're seeking equity, then obviously for whatever amount they'll be given a certain percentage of equity that they're offering up for sale at that event. Whenever they have raised that amount, that particular percentage, the event would end. Okay. Acha. That wraps up this chapter. I don't know if you have read this one till now or not. I'd like you to give it a read. The other thing is that we have to go through the questions. MCQs we'll do right now. The case study questions you'll do as homework. I'll mark them tomorrow. The next chapter, cash flow, I'd like to start tomorrow. So tomorrow's class, perhaps I'd like to start a bit early. And I mean, because that's one whole topic, I'd like to have it finished in one single go. Okay, so I can extend the class time. Hmm? It is manageable in one class easily. It should be. Okay. The book contains fewer details. Obviously, we'll be going into a few extra details. Also, the structures, they have just given you the skeleton. But when we discuss and we actually put in the figures, that might take a bit of time in explaining the concepts. If you could give me the answer to MCQs on page 217 of your book, please, for this chapter. Excellent. No, venture capital, it's long term. It's bank overdraft. You said that yesterday. Then startup and short term financing are different. A startup is seeking long term financing from the venture capital, bank overdraft. 9 would be inventories. Inventory is the purchases that you make in the form of raw materials, semi-finished goods, or finished goods of the things that you eventually want to sell. So, for example, if you are a stationery business, the different supplies, for example, the cardboards, the pencils, the colors, the markers that you're buying, they would be your inventory. If you are a business selling cars, then all the cars that you have got for sale in your garage or in your showroom, those would be your inventory. If you are a business selling furniture, all the furniture that you have got for sale in your showroom, that would be your inventory. If you are a business selling cricket bats, you would have raw wood, you would have handles and blades, and you would have finished bats at your shop lying around. All these three would be your inventory. So whatever your business has bought for eventual resale and selling, which is your main business, that is your inventory. So for inventories, what we usually do is when we buy inventory, we buy them on credit, and obviously we pay them at a later date. For wages, the reason it wouldn't work is that usually there are labor laws which tell you that you cannot unnecessarily or in ordinary circumstances delay the payment of labor and mass beyond this date or beyond this period of time. So labor laws cover that. For this is in the normal course of transactions of business that they carry out credit transactions and they defer the payment by whatever amount they have agreed on for inventories. So new shares on the stock market, it would be A. You're already new shares to existing shareholders. Sorry. Yes, you're right. C. New shares to existing shareholders. Correct. So for the questions that we have at the end, what is meant by short-term finance? This is 2 marks. अच्छा जी, retained profit 3 marks. अच्छा जी, main reason for using this method of finance 4 marks. And discuss the one advantage, one disadvantage, 5 marks. And then, sir, you have mm, assess whether Billionaire should fund the new factory through share capital or a mortgage. Good, 8 marks. ठीक है जी. Tomorrow's class we begin with discussion of your answers and then on to the cash flow thing. All right, see you.